Most of us were raised on a simple rule: save a portion of every paycheck and keep it in the bank. We treat that savings account like a fortress. But locking your cash away doesn't protect it. Instead, sitting idle guarantees your purchasing power slowly turns to ash. 30 years ago, this strategy actually worked. A standard fixed deposit in the 1990s could pay around 9%, easily beating inflation. Today, bank interest hovers around 5%, while the costs of housing, healthcare, and education surge far beyond that yield. Between 2020 and 2022, Western governments increased the money supply by 40%. When the supply of currency grows that much faster than the economy produces goods, the value of each individual unit drops. This hidden 8% annual debasement, added to consumer inflation, creates an 11% hurdle rate you must clear just to maintain your current lifestyle. To escape this decay, many people purchase a primary residence. We are told renting is throwing money away, and a house is the ultimate marker of financial success. This is a chart showing an amortization schedule for a standard 30-year mortgage. In the early years, interest consumes nearly 80% of a $3,000 monthly check. The actual principal debt remains virtually untouched, while the bank collects the majority of your housing budget. Add in property taxes, the constant maintenance and homeowners insurance, and the unrecoverable costs of owning equal or even exceed the cost of renting. A primary residence is a heavily leveraged consumption purchase that requires constant cash infusions to maintain. The reason saving and traditional homeownership no longer work dates back to 1971. The global financial system shifted when the United States suspended the dollar's direct convertibility to gold. This transition to fiat money allowed governments to endlessly increase the money supply to manage debt. When a currency loses its backing and the printing press works without limit, the unit of exchange eventually collapses. Historically, this unchecked debasement has forced citizens to use stacks of worthless paper as building blocks, serving as a warning of what happens when fiat money loses the public's trust. This chart illustrates the required return on your capital. Because the combination of inflation and currency debasement creates an 11% annual loss in purchasing power, your investments must consistently outpace that decay. To decide if a house is actually worth the cost, you need the price-to-rent ratio. By dividing a home's purchase price by the annual cost to rent a similar property, you arrive at this flashing 20. When this ratio exceeds 20, the math favors the renter. In major global cities where the ratio pushes towards 30, the monthly cost of financing the purchase price is significantly higher than the cost of rent. Renting in these high-ratio markets allows you to live in the asset at a discount. You let the landlord take the risk of market crashes or broken foundations, while you keep your capital liquid and ready for deployment. Buying that house also traps your capital. A 20% down payment becomes dead equity, cash locked inside a physical structure that produces no monthly income and cannot be easily moved to follow better opportunities. Notice the difference when you rent and invest that down payment instead. While the equity in a house sits static, $100,000 in the stock market historically clones itself roughly every 7 years, keeping your wealth accessible and growing. To build wealth in a debasing economy, you must keep your money moving. This is the velocity of money. Instead of parking cash in one place where it loses value to inflation, you must cycle it through assets to generate constant cash flow. The wealthy follow a systematic formula. They invest in an asset, use its cash flow or a refinance to get their original capital back as quickly as possible, and then move that same money into a second asset. This allows them to retain the original income-producing asset while using house money to acquire the next. They multiply their holdings exponentially, while their initial capital remains safe and ready for the next move. Advanced investors scale this velocity using overfunded permanent life insurance policies. They use these policies as a private bank, putting in more cash than is required for the insurance itself. The cash inside these specific policies grows tax-deferred, shielded from the immediate erosion of the standard financial system. This closed-loop system allows the owner to borrow against the policy's value to buy hard assets like real estate. Because the money was borrowed rather than withdrawn, the original capital continues to compound uninterrupted, even while it's being used to fund another investment. This strategy removes the need for traditional bank loans. While the middle class takes on debt to signal status through consumer goods, The Wealth Builder focuses on the behavioral discipline required to accumulate unspent assets. True wealth is the ability to control your own schedule. It is built from the invisible financial engines, the stocks, businesses, and policies that you haven't converted into physical stuff yet. To survive the long-term reality of a fiat economy, your money must stay in motion. Abandon the expired playbook, unchain your capital from static accounts, and buy